Hello traders, and welcome back to the Forex Chick. In today's video, I'll be sharing with you 4 best technical indicators for day trading. So as a day trader, you know how crucial it is to have the right tools in your arsenal to make informed decisions quickly. So technical indicators are essential for analyzing price action, identifying trends, and spotting potential entry and exit points. So whether you are new to day trading or an experienced trader looking to refine your strategies, understanding and effectively using these indicators can significantly improve your trading performance. So throughout this video, I will break down the most useful technical indicators, and I will explain how they work, and I will demonstrate how you can incorporate them into your day trading routine. So let's get started. The first technical indicator we'll discuss is the relative strength index, or RSI for short. So the RSI is a momentum oscillator that measures the speed and change of price movement. So it oscillates between 0 and 100, providing insights into whether an asset is overbought or oversold. So I'm going to put the RSI on our chart. So like I said, it oscillates between 0 and 100, providing insight into whether an asset is overbought or oversold. This is the TradingView platform, and this is Australian dollar against the US dollars on the daily chart, the daily time frame. So here's how the RSI works. When the RSI is above 70, see this, it's above 70, it indicates that the asset may be overbought and a potential price reversal could occur. Conversely, when the RSI is below 30, it suggests that the asset may be oversold and a price bounce could be imminent. So as you can see on the charts, when the RSI goes below 30, it means that it is oversold. You see this, and you could be looking to enter potential buying positions. You can see this rejection candle right here, signaling that yes, price may be looking for a reversal back to the upside, because you can see we are in a bullish trend right here. See this, so we're in a bullish trend here, and we could be looking to continue the trend. And the RSI went below 30, and you can see price giving us this confirmation with this hammer, this rejection candle right here, and continue the uptrend. So that's one way you can use the RSI. You can see price went above 70 here, which signifies overbought, and see price giving us a confirmation here with this morning star, and you can see price reversing to the downside. So that's how you can use the RSI to spot overbought and oversold conditions in the market. You can see this one, see another one right here. RSI going above 70 indicates overbought. See this, but price consolidated a lot right here. So this leads to my next point. Another way you can use the RSI is by spotting divergence on the between the price chart and the RSI, because the RSI sometimes produces false signals. So the best way, another way you can use the RSI is by spotting divergence in the market. So this is one example. You can see divergence means a bullish divergence occurs when the price makes a lower low but the RSI forms a higher low. So this suggests that the bearish momentum is weakening and a price reversal to the upside may be likely. Conversely, a bearish divergence happens when price makes a higher high but the RSI creates a lower high, indicating that the bullish momentum is waning and a price reversal to the downside may be imminent. You can see this price making lower lows here, but the RSI had other plans, was making higher lows. So that signifies a bullish divergence in play, and you can see price quickly reversing after that divergence. And you can see this one, see this bearish divergence here, price making higher highs, but you see the RSI making lower highs here. You can see price reversing from there. After that, price had this major reversal to the downside, and you can see this one here, price making lower lows, but the RSI is making higher lows. You can see the bullish reversal after that. See the bullish reversal to the upside. So that's how you can use divergence, RSI divergence, in your chart to make better trading decisions. So the next on my list is the stochastic. Next on my list is the stochastic oscillator. So this momentum indicator compares the closing price of an asset to its price range over a specific number of periods. So the stochastic oscillator consists of two lines, %K and %D. So I'm just gonna put that on the chart. So the stochastic oscillator. This is it, and you can see it. Like I said, it consists of two lines, %K and %D. You can see the two lines there. The %K is the main line, while the %D is the signal line. So the stochastic oscillator ranges from 0 to 100, just like the RSI. When the K line crosses above 80, it indicates that the asset is overbought and potential price reversal to the downside may occur. Conversely, when the K line crosses below 20, it suggests that the asset is oversold and potential price reversal to the upside may be imminent. And you can see this example here already. See this overbought condition. See this overbought condition right here, and you see price reverse after that. Price had this but reversed after this overbought condition right here, and you see that the stochastic has a lot of false signals, so it's always important you verify your signals and take trades in line with the trend. So that is how the stochastic oscillator works. When the K line crosses above 80, it means that price is overbought, and if it crosses below 20, it means that price is oversold. And like the RSI, the stochastic oscillator can produce false signals during strong trends. So to filter out these false signals, you can look for divergences between the stochastic oscillator and the price action, just like we did in the RSI with the RSI. So the next on my list is MACD, which is moving average convergence divergence. So I'm just going to put it on my chart. MACD. See, moving average convergence divergence, and this is it. So what is the MACD? The moving average convergence divergence, or MACD, is a powerful trend following momentum indicator that can help you identify potential trend changes and momentum shifts in the market. So the MACD consists of two lines. The MACD line and the signal line, as well as a histogram that represents the difference between these two lines. So the MACD line is calculated by subtracting the 26-period exponential moving average EMA from the 12-period EMA, and the signal line is a 9-period EMA of the MACD line. So when the MACD line crosses above the signal line, it generates a bullish signal, and when it crosses below the signal line, it produces a bearish signal. You can see, as you can see in this example, see this cross right here, generating a bearish signal. See, you can actually combine these indicators to generate better signals. Like the RSI, remember the RSI, this was an overbought, this level right here was an overbought level, and you can see the MACD confirms it. The stochastic oscillator also confirmed that yes, we should be selling from this level, and you can see another cross right here indicating a bullish signal. And see, the blue line crosses above the red line. The blue line is the MACD line and the red line is the signal line, and it indicates a potential buying opportunity. And we could confirm that with this rejection here, this hammer right here. So that is how you can use the MACD. And also the histogram represents the difference between the MACD line and the signal line. So when the histogram is positive and increasing with the green color, it indicates strengthening bullish momentum. When it's negative and decreasing and with the red color, as you can see here, it suggests strengthening bearish momentum. So the next on my list is the Bollinger Band, and that's the final technical indicator we will discuss for this video. I'm just going to delete this and let's put the Bollinger Bands on our chart. Bollinger, see, Bollinger Bands right there. So this is the Bollinger Bands. So Bollinger Bands is a versatile tool that can help you gauge an asset's volatility and identify potential breakouts or trend reversals. This indicator consists of three lines. We have a simple moving average SMA and two standard deviation lines above and below the SMA. So the blue line is the SMA and these are the two standard deviation lines above and below. So the upper and lower band expand and contract based on the asset's volatility. When the price is more volatile, the bands widen, and when the price is less volatile, the bands narrow. You can see. So this provides you with a visual representation of assets price range and potential trading opportunities. So as you can see on the chart, you can see this narrowing right here. It shows you that there's not much volatility in the market, and you can see when it expands like this right here, see this expansion right here, it means that yes, there's enough volatility in the market. You can see this expansion right here. Here there was a squeeze and here there's an expansion. It can help you tell whether there's volatility in the market. See this expansion here also. So that's how you can use the Bollinger Bands. Also, another way to use the Bollinger Band is to identify potential breakouts. So when price, for example here, when price breaks above the upper band or below the lower band with strong momentum, as you can see here, it might signify the start of a new trend. You can see we were bearish initially, but you can see this break with momentum right here. Price retested the SMA and continued the bullish trend. So that is one way you can use the Bollinger Bands. And another way you can use it is also by using the Bollinger Bounce, which is when price gets to the upper bands, upper lines, you can look to enter sell trades, and when it gets to the lower, when it retests the lower bands, you can look to enter buy trades. It's called the Bollinger Bands Bounce. See right here. Yeah, but this sometimes generates false signals, so you should always confirm with other indicators and also chart patterns. You can see this right here, you can see was confirmed with this engulfing pattern. We could look to enter sell trade there with our stop loss just above that high, and our take profit should be at the next support level, which is this. So that's how you can use the Bollinger Bands to make better trading decisions. So alright traders, we've come to the end of this video. I believe technical indicators are essential tools for day traders looking to make informed decisions in trading, forex trading. So by understanding and effectively applying indicators like the RSI, the stochastic oscillator, the Bollinger Bands, and the MACD, you can gain valuable insights into market momentum, volatility, trend strength, and potential reversals. Remember, no single indicator is perfect, and it's crucial to use them in combination with other forms of analysis such as price action or fundamental analysis to build a well-rounded trading strategy. So if you found this video helpful, please like, subscribe, and turn on the bell notifications to stay up to date with the latest content from the Forex Chick. Feel free to share your thoughts, experiences, or questions in the comment section below. Until next time, happy trading.